Assalamualaikum warahmatullahi wabarakatuh. My name is Nurhaliza binti Isa. Penyakit number is 196927. I would like to present about revenue cycle together with my group mates, is Alia, Zati, and Alina. I will present about process and document that involve in revenue cycle. For the process, firstly, customer will make order. Customer will make order through mail or phone and so on. And then company will receiving a customer's order. And then based on customer's order, company will issue sales order. The sales order for the authorization to sell. And then the sales order will send to credit department. The credit department will check customer credit for checking if for investigating the creditworthiness of the customer. And then when credit department approving credit for a sale, and then this procedure should be documented on the credit approval form. And then after approval, the purchase will continue sent to warehouse, and then warehouse will determine where the goods are available for shipment. And then if the warehouse find out that goods are available for shipment, then warehouse will release the goods for shipping. And then the goods will ship it. And then once together with the shipment, company will issue sales invoice for billing the customer. And then sales invoice will transfer to the customer, and then customer will check the sales invoice and also check remittance advice. And then the customer will pay minimum, which is the deposit and mail back to the company. And then company will check the remittance advice, remittance listing, and then and also deposit slip, and company will deposit it to the bank. And then company will collect money, collecting cash. And last process is recognizing effect of this process on other related accounts. So the source documents are involved is like in the slide, which is customer sales order, credit approval form, open order report, shipping document, sales invoice, and so on. The customer sales order is the document contains details of type and quantity of products of services ordered by customer, and also usually it is prepared and forwarded by a salesperson through mail or fax, or received by phone or over the internet. And then credit approval form. Credit approval form, like I mentioned earlier, to investigating the creditworthiness of the customer. And also this document is to be used to establish the customer's credit limit. And then open order report. Open order report is report of all customer orders for which processing has not been completed, perhaps because items ordered are out of stock or back order. Next, shipping document. Shipping document serves as a bill of lading and contains information of the type of product shipped, and quantity shipped and other relevant information. The shipping document is used to initiate the billing process. And then the sales invoice. Sales invoice it contains information on the type of product or service, the quantity, the price, and the term of trade. The original sales invoice is usually forwarded to the customer. Copies are distributed to other departments within the organization. And the sales invoice are a source document that signal the recognition of revenue. And then I will continue to the sales journal. The sales needs to be recorded in the accounting record. And customer statement. Customer statement is the details of sales, cash receipt, and credit memorandum transaction processed through the customer's account for the period. Account receivable subsidiary ledger contains an account and the details of the transaction with each customer. Its trial balance of accounts receivable um, is the accounts receivable is used to monitor the collection of receivables and to ensure that the details of the accounts receivable subsidiary ledger agree with the general ledger control account. Uh, these documents are used for the auditor to conduct a substantive audit work in account receivables. Next, remittance advice. Remittance advice is document that may be forwarded with the customer's bill and returned with the customer payment for goods or services. And these documents are contains information regarding with invoices are being paid by the customer. And then cash receipts journal. This journal is used to record the cash receipt. And then credit memorandum. The document is used to record credits for the return of goods in a customer's account or to record allowances that will be issued to the customer. Actually, uh, the process of document is same way as the sales invoice. And lastly is right of authorization. This document authorizes the write off of an uncollectible account. That's all from me. I will pass to the next presenter, Alina.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Alina Syafiqah binti Nur Azlin and my metric number is 197065. Next, I will continue with journal entries and account involved in revenue process. Basically, there are two important journals involved in revenue process, which are sales journal and cash receipt journal. These two journals, known as specialist journal, where they reduce the tedious task of recording both debit and credit general ledger account names and amounts in general journal. Firstly, the sales journal. Sales journal is used to record all credit sales. The term sales itself refers to the sale of goods in which the business normally deals. When the credit sales incurred, the sales invoice will issue by the company. Once the sale invoice is issued, the sales need to be recorded. In the journal, we will debiting the account receivables and crediting the sales. Okay, here is the format or the sample of the sales journal, which consists date, account debited, invoice number, post reference, accounts receivable and sales, and cost of goods sold and inventories columns. Okay, next is the cash receipts journal. Cash receipt journals is involved to manage all cash inflows, usually it is divided into several categories, which are receipt cash from cash sales, receipt cash from account receivable, and receipt cash from other sources such as interest income, scrap sales, or rent income. In this journal, we will debiting the cash, sales discount, and account receivable, and crediting sales and other account. Here is the format of the cash receipt journal, which consists date, account credited, post reference, explanation, debit and credit, and also cost of goods sold and inventory columns. In the explanation columns, we will briefly explain the reasons of the cash inflow. Okay, next is the sales return and allowance journal. This is the edition journal that we think that we should take because the sales return and allowance also can occur in the revenue process. Okay, this journal will involve if the customer return back the goods sold due to damage, defective, or low quality goods. The customer also can choose to accept the defective goods but in lower price, that also known as sales allowance. As a result, the company will need to prepare the credit memo. Okay, so here the sales return and allowance journal format, which consists date, credit memo number, amount credited, post reference, debit and credit, and also inventory and cost of goods sold columns. Okay, next, we will talk about the accounts that involve in the revenue process. Okay, so there are various types of account that affected by three types of transactions that typically process or involve in revenue process. Okay, firstly is because of sales transactions. The accounts that affected are accounts receivable, sales, allowance for doubtful debt, and bad debt expenses. Secondly is cash receipts transactions. The account affected is cash, trade accounts receivable, and cash discount. And finally, sales and returns allowance service transactions, which will affect the sales return, sales allowance, and trade account receivable. Okay, so next, I will talk about the revenue cycle flow chart. Okay, firstly, we will set the customer purchase order. Once they fill up the purchase order, whether through phone call, online platform, or fax, or etc. From the purchase order, we will prepare the sales order where it refers to the authorization to sell. Before we proceed to sell, we should check their credit, whether their credit goods or not. So the sales order, we will pass into the credit department. If the credit department approve the sales order, the copies of sales order will go to billing department, warehouse, and the shipping department. Okay, next, when the warehouse receive the sales order, warehouse will transfer the goods into the shipping department to be shipped. Okay, Then they will ship the goods by preparing bill of lading, will also known as shipping advice, where it will send over to billing department and also inventory control. The copy of billing of lading also will send to the customer as a packing sheet. Then the company will preparing the sales invoice and send the copy to the accounting department to record on the sales journal and also will be sent to the customer. After the customer will pay, the company will receive the check and remittance advice from the customer. Then the company will prepare the remittance listing. Okay, so next, the company also will preparing the deposit slip, where it will goes along with check to the bank. Remittance listing will be sent to the account department to record on the payment by the receivable. At the ending, at the end of the month, the company will make the bank reconciliations. Okay, that's all from me. Next.
Hi, I'm Raizati Iliani binti Zamri. I'm going to discuss on the internal control. So, internal controls are the mechanism, rules, or procedures implemented by a company in order to ensure the integrity of financial and accounting information, to promote accountability, and to prevent fraud from occurring in the company. So, next. Okay. One of the most important internal control that can be implemented by a company for the revenue process is to do a proper segregation of duties. In order to minimize the risk of errors and fraud, duties associated with the product and cash handling are often segregated. For example, if an individual have the duties to receive the cash payments from customer, then the one who needs to record the cash payment must be different person from the before. So these are the key segregation of duties in the revenue cycle. First, the credit function should be segregated from the billing function. For example, if one individual has the ability to grant the credit, then it must be separated from the one who has the billing function, because billing function for the customer, because it is possible for the sales to be made to customer who are not credit worthy if they are the same person. Okay. We need to avoid this situation because it can lead us to bad debts if the customer cannot pay for their goods or services. And next is the shipping function should be segregated from the billing function. Okay, the individual cannot have both responsibility to ship the goods and also involved in billing function, because the possible errors or fraud that can occur is unauthorized shipments to be made and for the usual billing procedure to be circumvented. So this all can result to unrecorded sales transaction and also theft of goods. Okay, the third one is the account receivable function should be segregated from the general ledger function. So if the individual is responsible for account receivable record, then the company needs to assign a different employee who needs to be responsible for the general ledger. This is because if both person can If both persons are responsible for both accounts, then they can conceal unauthorized shipments, and this will result in unrecorded sales transaction and theft of goods. And the last one is the cash receipt function should be segregated from the account receivable function. So the individual who has accessed both the cash receipts and the account receivable record, they may divert the cash, and when the shortage of cash occur, they can cover the crime. So as a result, the theft of the entity cash occurred. So this is the example of the segregation of duties for revenue cycles and account receivable function by department. So as you can see, individuals who are involved in the order entry, credit, shipping, or billing function should not have access to the account receivable records, general ledger, or cash receipt activity. This is in order to avoid theft or fraud, and also to avoid any error occur, so that if one person make an error, then another person can monitor and correct the error. Okay, next. Okay, next is control risk. Control risk is the risk of material misstatement in the financial statement arising due to the absence or failure in the operation of relevant controls of the entity. So, to avoid this control risk, organization must have adequate internal control in place to prevent and detect instances of fraud and error. Okay, so these are the three major steps in setting control risks for the revenue process. So first, we need to understand and document the revenue process based on reliance strategy. So a reliance strategy is an approach that the audit has decided to rely on the entity internal control. So it requires a more detailed understanding of the internal control. So there are 5 components of internal controls that we need to know. The first one is control environment, entity risk assessment process, control activities, information systems and communication, and also monitoring of controls. Okay, the second step of the control risk assessment is to plan and perform tests of controls on revenue transaction. In order to ensure that the control in the revenue process is operate effectively, the auditor can conduct tests of control such as inquiry of client personnel, inspection of documents and records, observation of the operation of the control, or walkthrough and re-performance by the auditor of the control activity. And the last step is to set and document the control risks for the revenue process. After all the tests of the controls are completed, the auditor needs to set the achieved level of control risk according to their plan. However, if the test of control does not achieve a plan level of substantive procedure, then the auditor can set the control risk at higher level than the plan. After that, they need to document the control risk either using quantitative amounts or qualitative terms such as high, low, or medium. Okay, next we will go through the inherent risk. Inherent risk is the risk posed by an error or omission in a financial statement due to a factor other than failure of internal control, which means that the auditor need to assess the likelihood of material misstatement before considering the effectiveness and impact of the client entity's internal control. So, these are the 4 specific inherent risk factors that may affect the revenue process. The first one is industry-related factors. The industry-related factors can increase the potential for misstatement to occur in the revenue process. So these are some of the examples of the industry-related factors. The first one is profitability and health of the industry. If the entity if the industry that the entity operates are in bad condition, then it will also affect the entity, such as they will encounter low sales volume and lack of demand for their products, which then will also lead to operating loss. Other than that, high number of competition can also affect the entity's pricing policies or credit terms in order for them to compete with the competitors. Okay, next is rate of technological change. An entity in the fast-changing high technology industry may faces a risk of inventory obsolescence. This is because rapid innovations can cause the entity products to become obsolete very quickly, and the inventory may not be appropriately valued. So, other than that, there are also level of governmental regulation. The level of governmental regulation within the industry can also affect the sales activity of the entity. So all these risks I mentioned is inherent in the business of the entity. So if these industry related factors are present, so the management may engage in activities that can result in misstatement. So recognizing this fact, the audit firm will probably decide that there is a high inherent risk, and hence they need to conduct more extensive tests and more carefully review the risk. Okay. The second factor is the complexity and the contentiousness of revenue recognition issues. So most entities recognize revenue when the product is shipped or service is provided. However, inherent risk can occur if the revenue recognition involves a complex calculation, such as recognition of revenue for a long-term contract, lease contract, and installment sales. So this complicated calculation can affect the accuracy of information, and the cutoff, such as the revenue transaction, may be recorded in wrong period. So for this risk of material misstatement, the auditor need to assess it as high risk, as it requires complicated calculation to assess, which makes the possibility for errors to occur is high. The third factor is the difficulty of auditing transaction and account balances. So there are some transactions that are difficult to audit and may cause inherent risks, such as management estimate for the allowance and collectible accounts and sales returns. In this situation, the management of the client entity needs to exercise a great deal of judgment in estimating and recording transactions. So the greater the exercise of judgment required, the greater the likelihood of misstatement to occur. Thus, the auditor is likely to assess a high inherent risk. And finally, the fourth factor is misstatement detected in prior audits. So previous audit is really important in order for us to assess the potential for misstatement in the current year. So if material misstatement were discovered in the previous audit, it is possible that the same kind of material misstatement may have occurred in the current year. So for example, when material misstatement in pricing inventory had been discovered in the previous audit, then the auditor tend to use a high inherent risk in the current year audit and perform more extensive tests in order to assess whether the deficiency in the client system has been followed up and amended. Okay, that's all. Alia will continue the presentation.
Hi, my name is Nurul Alia Akila binti Abdullah. My metric number is 199178. Now, I will explain to you the important assertions for the revenue cycle. First and foremost, it is important to understand that the managements are responsible for fair presentation in financial statement. Assertion is the representation of fair presentation. So these assertions became the audit objective for the auditors to obtain sufficient and appropriate evidence to ensure that all these assertions are being met by the management. So looking through looking through the screen, we have three types of transaction, which is transaction and events for the period, account balance at the end of period, presentation and disclosure. So first, I will explain the transaction and events for the period. As mentioned by my previous presenter, Alina, in this revenue cycle, we are going to have three important transactions, which is revenue or sales transaction, cash receipt transaction, and also sales revenue and allowance transaction. So let us move on to assertion for the revenue transaction. So for the occurrence, management need to ensure that all revenue transaction and events have been recorded pertain to entity. Completeness, all the management need to ensure that all revenue transaction and events occurred have been recorded. Next, authorization. It is the management's duty to make sure that the revenue transaction and events are properly authorized. And for the accuracy, amounts and other data relating the revenue transaction and events have been recorded properly. It is important to record the amount of transaction or other data correctly in order to avoid material misstatement. Next, for cut-off, management need to ensure that all revenue transaction and event is recorded in the correct accounting period. And for classification, management needs to ensure that all the revenue transaction and events have been recorded in proper account. Next, for the assertion of cash receipt, occurrence, firstly, occurrence, it is the management duty to ensure that all cash receipts and events have been recorded pertain to entity. Next, completeness. Management needs to ensure that cash receipts and events occurred have been recorded. And next, authorization. Management is required to ensure that all the cash receipts and events are properly authorized. For the accuracy, amounts and other data relating cash receipts and events should be recorded properly by the management. Cut off, the management needs to ensure that all the cash receipts and event is recorded in the correct accounting period. For example, all the cash receipts transaction occurs in 2019, so the transaction needs to be recorded in 2019, not in 2018 or 2020. Lastly, for classification, management needs to ensure that all the cash receipts and events have been recorded in proper account to avoid any confusion. For the third transaction, which is the sales return and allowances transaction, the assertion for these transactions are not material for most entities because these transactions often are few in numbers and do not represent a material amount in financial statement. However, I want to highlight two assertions, which is occurrence and authorization, which the management needs to ensure that the occurrence of sales return and allowances transaction truly occurred, and this transaction have the authorization from the management. However, the auditor may choose to gain understanding of how this transaction is handled because substantive analytical procedures are usually performed to test the sales and allowances return. Next, we move on to the second category of assertion, which is assertions for the account balances period end. For existence, account receivable and related account must exist. So this is the duty of manager. They need to ensure that this account exists. Next, for rights and obligation, the entity holds or controls the rights to account receivable and related accounts, meaning management needs to ensure that they have the rights towards the specific account. For example, lease account, capital lease. Next, we have completeness. Completeness is where the management needs to ensure that all account receivable and other related accounts have been recorded. And lastly, valuation and allocation. The management needs to ensure that the account receivables and other related accounts are recorded in the appropriate amount in financial statement to avoid any material misstatement. And the last category, which is the assertion for presentation and disclosure. Firstly, we have occurrence and rights and obligation, where the management needs to ensure that all events, transaction matters relating to account receivable and related account have occurred and pertain to entity. Next, completeness. Management needs to make sure that all disclosed events, transactions, any matters relating to account receivable that should be in financial statement are included in the financial statement. Next, for classification and understandability, the management needs to ensure that all the accounts are properly classified and the financial statement are presented, described, and clearly expressed so that it is understandable. Next, for accuracy and valuation, the management needs to ensure that financial and other information relating to account receivable and other related account are disclosed at fairly appropriate amount to avoid any material misstatement. Next, I have explained to you the management assertions. So now this is the duty for the auditor to carry out, to investigate, and to obtain sufficient and appropriate audit evidence by using audit procedures. So as you can see from the screen, this is the audit procedures that can be done by the auditors. The auditors can inspect records and documents. They can also inspect tangible asset. They can conduct an observation. They can carry out an inquiry or external confirmation. They can also have a recalculation, reperformance, and they can also conduct an analytical procedures and also scanning. So let us move on to the relevant audit procedure for the revenue cycle. Firstly, I would like to cover the relevant audit procedure for transaction and events. So first, for the occurrence, the possible misstatement that could arise from this situation is from the entity is the fictitious revenue. What is fictitious revenue? Fictitious revenue is fabricated sales or revenue that could potentially lead to fraud. So what the management can do, the management can segregate the duties to ensure there are no fraud or any other kind of So what the management can do, the management can implement segregation of duties. So here, auditor can observe and evaluate whether the proper segregation duties are carried out and whether this segregation of duties is effective and efficient for the entity. Next, the possible misstatement that could arise from the entity is the cash receipts is recorded but not received or deposited. So the management can ensure that this issue won't occur is by having the bank reconciliation is prepared regularly and independently review. So what the auditors can do is they can conduct and they can review bank reconciliation. Next, for completeness, the possible misstatement that could arise from the entity is that the goods and services are shipped and performed, but there are no revenue recorded. So the example of control activity that can be carried out by the management is the management can do accounting for numerical sequence of shipping document and invoice. So here, the auditor can trace the shipping document to the respective sales invoice. Another possible misstatement that arises from completeness is that the cash receipt are received or deposited, but it is not recorded. So what can the management do? The management can implement the use of electronic cash receipt. So once they have implemented use of electronic cash receipt, the auditor can examine the application controls for the cash receipt transfer. Next, we will go to the authorization. The possible issues that could arise from the possible misstatement that could arise from authorization is that the goods and services performed for a customer with bad credit risk. So what can be done? What can be done by the management? So management can implement proper procedure for credit and shipment of goods and authorization. Why it is important to implement proper procedures? Because management needs to filter their customer who have bad reputation. So what the auditor can do, the auditor can review the entity procedure for credit purchase. Next, for authorization, there are the possibility where the cash discounts are not properly taken. So the management need to properly implement a procedure for cash discounts authorizations. So example test of control that can be done by the auditor is that the auditor can review and test the entity's procedure to control the cash discount, whether it is efficient and effective for the company. And lastly, and next, for the accuracy, the possible misstatement that could arise from accuracy is that the amount for revenue transaction recorded is incorrect. So what can be taken? What can be done by the management? They can use the sales invoice and reconcile it to the daily sales report. By doing this, they can reduce the possibility that the amount for revenue transaction recorded incorrectly. So what can the auditor do? The auditor can examine the reconciliation of sales invoice to daily sales report. When the amount of revenue transactions recorded incorrectly, it is possible that if the amount is in a large sum, it is possible for material misstatement to occur. Next, the amount for cash receipts recorded is incorrect. So when this is as same as when the revenue transaction is recorded incorrectly, the management can use the bank statement and reconcile it regularly and independently reviewed. So the auditor could then review and test the reconciliation whether it's effective, efficient, and independently reviewed by independent party. So I would like to highlight the assertions for accuracy is when the amount is very big, as I mentioned just now. If the amount is very big in number, the possibility of a material misstatement could occur, and when there is a material misstatement, it will affect the audit opinion later on. Next, cut-off. The possible issues that could arise from cut-off is the revenue transaction or cash receipts is recorded in the wrong period. So when this, in order to control this misstatement, the management can ship the documents forwarded to the billing function. The management can give instruction for them to ensure that the shipping documents forwarded to the billing function daily, and the cash receipts at before and after are reconciled in an accounting period. So what the auditors can do to obtain evidence on the assertions of cut-off is they can compare the dates on sales invoice and relevant documents such as shipping document. So this could and next, the auditor can review and test the reconciliation of the cash receipts. And lastly, for classification, the possible misstatement that could arise from this assertion is that the revenue transactions are not properly classified, and the cash receipts recorded is in the wrong financial statement account. So what can the management do? The management can implement chart of accounts where the accounts are properly labeled accordingly. So this could help to reduce the misstatement where the accounts are not properly classified. So what can the auditor do? The auditor can review the sales journals and general ledger for proper classification, and for the cash receipts recorded in the wrong financial statement, the auditor can review the cash receipts for any unusual item that rises that could give a red flag for the auditors. Next, we move on to the substantive analytical procedure for sales return and allowance. As I mentioned just now, next we move on to the assertion for sales return and allowances. So as I mentioned before, for sales return and allowances, we are going to conduct a substantive analytical procedure. So I would like to highlight two assertions here. Firstly, the occurrence, and secondly, the authorization. So for the occurrence, the possible misstatement that could occur from sales return and allowances transaction is fictitious revenue and misappropriation of cash. So for fictitious revenue, the management can control by ensuring the monthly customer statements are given to the customer, and the auditor can review and test the entity's procedure for mailing and complaints about monthly statement. Next, for misappropriation of cash, the management can segregate the duties to ensure that there is no overlapping in duties to avoid any cases. So the substantive test of details that can be carried out by the auditors can observe and evaluate proper segregation duties. Next, for the authorization, it is important for the sales return and allowances transactions to have authorizations from management. So the possible misstatement that could occur in this transaction is that the transaction is not authorized, and management could reduce this possible misstatement by having a proper entity procedure for authorizing sales return and allowances. The substantive test of details that can be carried out by the auditor is that they can review sample of credit memo for a proper approval and the presence of the receiving documents. Next, we move on to substantive analytical procedure for account receivable and related accounts. So for substantive analytical procedure, we divided it into three categories: revenue, account receivable, allowance for uncollectible accounts and bad debt expense, sales return and allowances, and sales commission. So for revenue, the example of substantive analytical procedure that we can carry out is the auditor can carry out is the comparison of gross profit percentage by product line with previous years and industry data. So when we conduct this procedure, it is possible for us to detect an unrecorded revenue and fictitious revenue. Next, for account receivable, allowance for uncollectible accounts and bad debt expense, we can the auditor can compare the receivables turnover and days outstanding in account receivable to previous year or industry data. So when this procedure is conducted, it is possible to find out whether there is an understatement or overstatement of allowance for uncollectible amounts and bad debt expense. And for sales return and allowances and sales commission, we can conduct a comparison of sales return as a percentage of revenue to previous years or industry data. And from there, we can identify whether the sales return, sales discount, and sales commission have an understatement or overstatement. Next, we move on to the test of details for account balances. For existent, the test of details that we should conduct is to confirm selected account receivable. So for right and obligation, the review bank confirmation, we can conduct a review bank confirmation for any lines on receivables. For completeness, the test of details that we can carry out is to obtain an age trial balance of accounts receivable and agree to the general ledger accounts. And lastly, for valuation and allocation, we can examine the result confirmation of selected account receivable. And lastly, the test of details for disclosure is, test details of disclosure. So for the firstly, for the assertion of occurrence and rights and obligation, the test details that could be conducted is auditor can determine whether any receivables have been pledged, assigned, or discounted. For completeness, auditor can complete financial reporting checklist to ensure all financial statement and disclosure related to the account have been disclosed. And for classification and understandability, auditor can review the age trial balance for material credits, long-term receivables, and non-receivables. For accuracy and valuation, the auditor can read notes and other information to ensure that the information is accurate and properly presented at the appropriate amount. So it is important for the auditor to obtain sufficient and appropriate audit evidence through audit procedure in order to ensure that the management assertion are being met by the manager. That's all from my group. Thank you.